Well, here's my starting point, and I guess, again, it's sort of nothing really new to a lot of people, but and I joke about this often and say, you may have heard this 450 times, but that's still not enough, and here is number 451. It's critical that you develop a trading plan that's right for you, suits your personality, resonates with you, just makes a lot of sense, makes you feel comfortable. You're comfortable with the risk and the risk you take, and you can tolerate that. And then once you've developed that, and of course that's no easy task, that doesn't happen within one day. That is a process, and I'll talk about that in my session today. It's very much a journey and a process to get to that point. But then once we've had that, of course, it's just as important that we execute and implement that plan with the right sort of attitude and the right mindset and the right, I guess, skills. And we're disciplined and we're decisive and we're patient, and a few of those other, solid trader attributes that if we want to do this well, we really need to develop and become the best in if we want to be successful at this. But I can't overstate the importance of developing a plan that's right for you, resonates with you, and then of course implementing that with the right mindset. But again, probably nothing new to a lot of people. Over on the right-hand side there, the image, just really provides us an overview of the different components of our plan. The money, of course, is managing our risk and manage our exposure and our money. Things like how we allocate capital to individual trades, i.e. what's our formula to position size and determine trade size. How do we set stops? How do we set our initial stop loss? Do we take profit? Do we use trailing exits? If we do, how do we do it? If we do both, under what circumstances do we pick one over the other? And how do we determine those sizes and how far away our stops are going to be? And then, of course, doing all the calculations on reward to risk and having that as part of our selection or trade selection process as well. That's all the money side of things, and of course that's another topic which can be covered in excruciating detail. Then we have the methodology, which I will focus a lot more on today, and that is of course our strategy and how we have a process of trying to identify trading opportunities, because that's really what the methodology is all about, trying to present to us on a regular basis trading opportunities which have a high likelihood or probability of delivering us a positive outcome. And of course that positive outcome is a profit. But that's all we're trying to do, is have a process which delivers to us regularly high probability trading opportunities, high likelihood of positive outcome. And then of course down below there, supporting it all and underpinning it all, is the 6 inches in between our ears, and that's our psychology and our mindset, and that's the glue that keeps it all together. So it's all very well and good to have a plan, but we need to be totally committed and disciplined and decisive and all those other attributes which I won't cover today to help us implement and execute that plan. So I talk about process a lot. I believe trading is a process. I don't believe a lot of people do trade as a process, and unfortunately I believe a lot of people trade randomly. They randomly look for trading opportunities. So what I'll do now is just quickly go to the first chart, and what it is irrelevant. It just so happens to be the chart of Australia's main stock index, the S&P ASX 200. It could be anything. But my concern with so many people is that they'll look at a chart like this because this is part of their trading universe. This is one of the products that they might have within their universe to trade. And of course we're looking at the right-hand edge because that's current and where we need to make a decision. Unfortunately, I find too many people trade randomly. They will look at a chart like this and almost hope that something becomes obvious. Something jumps out, something like some chart pattern, or maybe the moving average is doing something, or maybe they have an indicator down below and that also presents some crossover or some signal or something. They literally will look at this, and then they might get a drawing tool out and draw a trend line across the top there, or they'll draw it at 5,000 and see some support and the like. Maybe they'll zoom in a little bit, maybe they'll zoom out, maybe they'll tilt their head a little bit to the left or to the right to try to see if some lines line up and align. And we can look at this for some time. Then we can change the periodicity on the chart. We can change it from a daily to a weekly. And then of course we have real-time MetaStock. We go even lower than that. We go down to a 1 hour chart, or we'll go to a 1 minute, or whatever it might be. But we're doing this hoping that something pops out. Now, this to me is a very random, indiscriminate way to trade, and I don't think it's a very good way to trade. Yet, if you don't know any better, it's an obvious way to trade. It's what traders do. They look at charts and try to find opportunities to trade. Now, we could spend 15 minutes on this chart, one chart, out of maybe 50 stocks or 200 or 500. We could spend 10 to 15 minutes on this chart and still not get anything, and still not get anywhere. And it's a very inefficient way to do this. And my whole lesson today, or the theme of what I want to try to tell people, is trading is a process where we do the same thing over and over and over again. And what we need to do is develop a strategy that we implement over and over and over again. And I'll talk about that a little bit later when I talk about the consistency and the greatest exponent of consistency and how that works for them and how we can take those lessons away as traders. But it's a very random, indiscriminate way to trade, and I don't think it's a very good way to trade by any stretch. So what traders do, what we do is we have a process, and that process defines and follows a plan. We then identify high probability, right? That's that likelihood or chance, high probability trading opportunities, and hopefully with good reward to risk. Now, I'm not talking about reward to risk or risk management or anything at any other point in this session, but all I'm saying about is, risking X number of cents, but the reward is actually less than that. So, having a reward to risk of less than 1 to 1. And, you need a very, very high strike rate. Anyway, you need to work out the calculations and the numbers and make sure, of course, that's all to your advantage. That to me is what trading is all about. It's a process where we define and follow a plan. That plan identifies high probability. We don't focus on profitability, we focus on probability with good reward to risk. I'm a technical analyst. It's fortunate that MetaStock is a great piece of technical analysis software. I've been using MetaStock myself since 1999, version 6.52 if memory serves. So I'm very much a technical analyst. Now, my more active trading is not in stocks, it's in currencies, and I do accept that currencies are a very news-driven market, but I also still believe very strongly that technical analysis is very effective. The good thing about technical analysis, and I'm not going to try to enter a debate here with TA versus fundamental analysis, but I think the good thing with TA, or technical analysis, is it all comes back to data and allowing us to have data-driven decisions. And I think that's wonderful. Allowing us to be very unemotional, quite objective, quite clinical in the rules that we create ourselves, and allow us to be data-driven. And I think traders should think in terms of data-driven and not emotional-driven or impulse-driven, but more data-driven. That's the great thing about MetaStock. And please don't get me wrong, I'm not here to sell you the software, but the great thing about the Exploration or the Explorer, which I have used, must be tens of thousands of times I've opened up the Explorer and run an Exploration. And the great thing about that, of course, is that helps you with that consistency. It allows you to be very consistent and only look for clearly defined criterion, and it won't show you anything else. It only shows you those that meet the criterion. So having a tool like that is quite advantageous, but of course we need to know what to put into it in the first place, don't we? So let's talk about that a little bit more. And finally, my 3 C words when it comes to trading. This is all my sort of introduction to trading and just giving you a bit more of my philosophy and the way I see things. My 3 C words are consistency, which I've mentioned a few times in everything we do, comfort in the level of risk we are taking, and confidence in everything we're doing. Confidence in ourselves and our own ability, and confidence in the trading plan that we have developed to allow us to implement that very, very well. And I believe those 3 C words are very important when it comes to trading. I'll obviously talk about consistency a lot more. So I just want to finish on this point so we can get more into the strategy and talk about some technical analysis rules and the like. So I just wanted to wrap up this session with 2 more slides. Again, a little bit of my philosophy. Trading to me is a process. It is a rules-based activity. And those who do it well will always talk about rules, always. Rules are there to protect you from yourself, from doing really silly things. That's why we have rules. The rules are often counterintuitive, which is why it comes back to us to have the discipline to ensure we follow through with those rules, even though they may not sit overly well with us. You may have heard the quote, and I think it's a sensational quote, which says, trading is simple, but it's not easy. Right? Trading is simple, but it's not easy. So the time-tested principles that we need to follow, like cutting a losing trade, are very straightforward, are very simple concepts, but it's not easy for us to implement and follow those. So trading is simple, but it's not easy. And finally, just think in terms of who traders are. You cannot look at someone and say, wow, they're a really good trader. You just don't know. It's all from within. But traders are very good at what they do, and they are disciplined professionals. But I think the bottom point is probably all-encompassing, and that is they have simply allocated the amount of time, devoted time and energy and effort, and no doubt money in training and the like, to put themselves in a position to do, to trade well. And I think that's a real obstacle. It's a real issue with trading. There's no barrier to entry. There's no obvious pathway to become a trader. So if you're like me, when I started, I thought trading would be easy money. I mean, how difficult can buying and selling really be? That's all you have to do. How difficult can it be? So I thought it would be easy money, and then unfortunately I learned very, very quickly that it was probably the hardest easy money there was. So there's no barrier to entry, there's no obvious pathway, and traders have certainly allocated, and I, again, couldn't begin to estimate the number of times I've spent in MetaStock, would you believe, when I started in 1999, testing and validating and proving things and disproving and trying different parameters and changing that moving average to something else. And the amount of times I've spent a lot of time, and I find now that that time was well spent, but it was a lot of time. Okay, finally on the trading plan. Again, very, very simple, but just to make it very clear where I'm coming from. Your trading plan at a bare minimum, all it needs to have is a response to 3 questions. That's it. That's all your trading plan really has to have. Those 3 questions are, under what conditions will you enter a trade? How much money will you risk? How much money will you commit? How many units will you trade? Or I won't use CFDs, but stocks or lots or contracts. And then, of course, finally, and hopefully obvious, is under what circumstances, under what conditions will you exit a trade, right? So how do we get in? How much money do we risk? And how do we get out? Very straightforward, but your trading plan needs to respond to those 3 questions. But interestingly enough, if you tell a beginner trader that question number 1 there is really not that important, they will dismiss that. They will laugh at you. They'll just say, you must be kidding. Because it's obvious that the decision you make to enter a trade clearly has a large influence or impact on the result of that trade. And once you've been trading for some time, or even not that long at all, you appreciate that that's really not the case at all. So when it comes to importance, really under what conditions will you get out becomes now number 1. The order is reversed. How much money you commit to the trade is a close second, and how we allocate capital and manage our money. And then in a distant third, well down the straight, is under what conditions will you get in. So why do I do this? Well, again, it's my beliefs and what I believe to be true, but it also puts into perspective everything that I'm talking about today. And when I talk about technical analysis and I talk about developing rules and considering support and resistance, or using that indicator or using something, we need to put this into perspective and realize that how we get out of trades is almost everything. Right? Almost everything. Now, of course, it's all part of our strategy, but when people talk about strategy, they very much focus on entry. But strategy really is everything. How you allocate capital is part of your plan. It's part of how you approach the market. How you get out of losing trades is very much a part of your strategy. Absolutely it is. Unfortunately, it's not paid the due attention or focus, but it really should be. Now, my session today is not to talk about managing risk and how to set stops. In fact, I did a webinar not so long ago on managing risk, which I think is available on the MetaStock YouTube channel, just for an hour, just like this. And that provides that sort of emphasis on managing risk, but it's all part of the process. It's all part of the strategy. And then it's how do we get in, how much do we risk, how do we get out? Okay, finally, before I get into the strategy, I've talked about a few of these things already. I just want to quickly run through my trading beliefs. And a few of them, as you read through them yourself, I've obviously already talked about, so I won't spend much more time on them. I have said I believe trading is a process. I do believe in consistency being very important. One thing that I have not mentioned is less is more. I believe strongly that if you trade less, it's probably better for your financial or trading health or your chances of success. There can be an instinct, an intuition, a want to trade often and regularly and be very, very active. And it's maybe intuitive to think that the more you trade, the more trade you place, the better chance you have of making money, the better chance you have of, realizing profits. That's probably makes a lot of sense. I believe that people often trade too much and that trading less is a very, very good approach. All right, so I believe in less is more. Now, no broker will tell you that, obviously, because a lot of brokers make revenue, make money from activity and volume and people trading and charging commissions and brokerage and the like. So no broker will tell you that, that's for sure, because they want you doing things. But I believe for your trading health, trading less is actually better for you. I also believe your best trades take time. Your best trades, your most profitable, the ones that you remember 12 months later, they take time. They rarely happen overnight. And why I say that is because we need to have the process in place to ensure that we can enjoy those best trades, and we have the patience, and we have the the process, the rules in place, the trailing exit, hopefully within MetaStock, that allows you to enjoy every bit of that very profitable and your best trade. They do take time. Depending on your trading style, it could be months that your best trade takes to develop and move very, very well for you. One thing I will talk a bit more about today is don't use things in isolation. So when we talk about developing a strategy, a simple strategy, I'm not saying it's the best, I'm not saying you should use it, but a simple strategy is taking two moving averages, and every time they cross, physically intersect with each other, that generates a signal to trade either long or short. That's a strategy, right? That's a signal right there. It's not the best, but it is a signal. It is an entry signal. Trading that in isolation is to use that and only that. Now, I believe you could make that signal far better by accompanying it with other conditions or criterions. You may consider support and resistance. You may consider the longer term trend and only trade in the direction of the overall trend and not against it, as an example. So you can improve that signal. So I don't believe trading things in isolation. One of my favorite candlestick patterns is a doji. It often, represents a reversal. Indecision, if you have a very strong prevailing trend and then see a few dojis in a row, you often see a reversal, as an example. Would you therefore trade every single time you see a doji? You could, but I think you could improve that signal by accompanying it with other conditions. That's what I mean about trading or using things in isolation. Two more, keep it simple. I've mentioned this a bit already. I was mentioned in my introduction, I'm the author of a book, Trading in a Nutshell. Every time I sign a copy of that book and give it to someone who, of course, exchanges cash for that book, I always, just above my signature, I always write 3 words, and it's those 3 words. I always write, keep it simple. Don't complicate this. Don't make it really complex. Trading can be simple. Simple does work. It makes it easier for you to implement and to follow through and to stick to the plan. There's so many benefits in being simple and keeping it simple, and I certainly cannot overstate that. Excuse me. And finally, data-driven decisions. I've said this a little bit. I'm actually going to mention or show you an example right now, if you allow me. Just bear with me for a second while that comes across to your screen. And just quickly, there's been quite a few more people join us since I began earlier, so a very warm welcome to all of you as well, and thank you very much for taking your time to listen to me speak today. I really appreciate it. An example of data-driven is, here's, as I mentioned, this is a stock index. It's the S&P ASX 200. It's Australia's main index, and of course you would have your own TSX and what have you. Excuse me, but at the top of this chart, I have just a very simple red line. And this is one of my tools that I developed so long ago. It's not funny and it's not that complex, and I could read off the formula for you right now. I could even show you on the screen, obviously. It's simply a volatility percentage indicator that I developed. Volatility percentage. So yes, we have the average true range, ATR, which I love as an indicator, and my exits are based on ATR, on volatility, which I might show you later on. So what I've taken is the ATR of X, whatever X might be. In this case, it's an index. And then I've divided that by the value of X. So I've turned that into a percentage, basically, and multiplied that by 100. And what I've noticed here, and this is, I can put this on all global indices at the moment, and you'll find that it'll be very, very similar. And what we've seen over the last month, this is a daily chart, what we've seen over the last month is this indicator breach one of my thresholds. It's moved beyond 1.5%. And if I was to show you historically, this generally ranges between, there we go, generally is between 0.5% and 1.5% as I zoom back there and just show you some historical perspective. And for the first time, just waiting for that to come through on your screen, for the first time in more than 4 years, it's actually moved back above that level. Now what that says to me is the volatility of the index has gone beyond normal sort of normal parameters or normal range, and it's really getting into quite silly territory. Now the good thing about ATR is taking over 20 or 30, excuse me a sec. Sorry about that. The good thing about ATR, using 20 periods or 30 is, one day out of the blue that is very, very volatile, it ignores that because it's after an average. But when that average then moves beyond that threshold, which it now has done and has remained quite high, it's telling me the index is getting a little bit silly, a little bit sort of irrational, et cetera, et cetera. So what that can be is, and what I tell people is this could be a decision you make based on managing risk, for example. It might mean that the index has moved, beyond normal sort of ranges and become a little bit irrational, a bit silly. That might be a trigger to me to modify the way I trade. It might mean I trade, stop trading. It might mean I trade half sizes. It might mean I trade, just fewer positions. It could mean anything. But all I'm doing is having the data drive my decisions. And that to me is really, really important. That's just a very simple example. I have numerous examples of this, but that's just a simple example of a data-driven decision. Okay, enough on that. Again, if there's any questions, any messages you're able to get through, I'd be more than happy to respond to those and do my very best to answer and help you out. Okay. Well, let's talk a little bit more now specifically about technical analysis, developing rules, and putting a strategy together. Again, a little bit more of my belief, if you don't mind. Technical analysis, or TA, is simply an approach. It's the one I use. I find it very, very effective, but it's not the only one. Clearly, a lot of people conduct fundamental analysis, and I won't go into too much detail about what all that is about, but looking a little bit more at the physical thing that you are trading and all about that item, whether it be a company or a currency or whatever it might be. It is certainly not perfect. It is far from perfect, but it is an approach, and I am very much myself a technical analyst. But TA can also be incredibly complicated and mathematical. Some of the formulas for some of the indicators found in MetaStock and others are incredibly complex formulas, really, really complicated. And trading, technical analysis can be that complicated. But I also believe in that it should be kept quite simple. And again, I think, I might have mentioned this earlier, I think when we start trading, we think trading, well, I certainly did, and I think a lot of people do, thought trading would be easy money. We then realise it's probably the hardest easy money there is. And when we appreciate that trading is actually quite difficult, or certainly more difficult than we thought it was going to be, excuse me, we intuitively then or instinctively move towards a more complex or complicated solution to be successful at trading. So much so that if I was to present you a very simple technique or a simple signal or strategy, you might almost subconsciously dismiss it, realizing that, well, trading is more difficult than that. That couldn't possibly work. That's too simple. That's too straightforward. Trading is more difficult. So we can easily think that, and I know that that's not the case at all. Trading can be really quite straightforward. Trading rules can be quite simple, and they can actually work, but it's counterintuitive. It's counterintuitive to think that a simple approach can be successful at what we perceive to be a difficult endeavour. It just doesn't make any sense, and therefore we put up barriers almost to looking at anything that's quite simple and straightforward. And as I mentioned earlier, any form of analysis, whether it be TA or fundamentals, all we're trying to do is increase probability, likelihood, chance of a profitable trade, and I do believe in consistency. Now, I've had a bit of fun with this slide, and I put this together some number of years ago. If you can look down the bottom, you'll see the scale being from quite a few years ago. Just waiting for that to come through on your screen. There it is. Yep, so I've had a bit of fun here. I've done a lot of personal coaching over the years. I've not just in Australia, but in other countries as well, and I've sat down with people one-on-one for 2 hours or 4 hours or even the whole day. And if I've never met that person before, I say, okay, take your time, spend as long as you wish. Can you tell me about your trading right now? You just give me a great idea of what you are doing, and then we'll take the session from there. Every now and again, I will have a chart that looks quite similar to this. Now, I've obviously put this together and had some fun doing it. I've gone into MetaStock and I've just applied almost everything I could find. But I will see a chart every now and again like this, and I just shake my head and think, this is horrible. This is not trading. This is not technical analysis. Just because the software can do it and put it on a chart doesn't mean you need to use it. This to me is completely going down the wrong path. And then they begin their explanation. Oh, well, you see that line there, if that crosses above that one and changes to orange, and if that angle there is more than 47 degrees, and if the stock code begins with the letter M and blah, 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 off they go. Just takes them 10 minutes to explain their entry. This to me is not trading. It's not technical analysis. It's playing with MetaStock. That's all that is. It's certainly not trading, it's playing with MetaStock. So I very much believe in simplicity, and I hope the remaining things that I talk about today, that will come across as being really important, and that is keeping it simple. Okay, again, just waiting for that screen to flick through. Okay, let's talk more practical now. What we need to do is develop, as I said, a trading style, a trading strategy that is going to work for us. One of those things is time frame, and this is really important. When we come to a piece of software, that allows us to select multiple timeframes like MetaStock does. And you'll see some other, online platforms and perhaps currency platforms that even go down to 1 second and et cetera, and have quite a number of different timeframes or periodicities available to you. When I talked earlier about trading randomly, this can be a problem. If we don't clearly identify our time frame and our trading style, what we will do as part of our process looking for opportunities is we will run this menu. We will start somewhere and we'll go up and we'll go down looking for different trading opportunities. More likely we'll go up and we'll go into the intraday timeframes and go to 1 hour and 30 minute and 10 minute and so forth, looking for opportunities. But the way you trade a 5-minute chart is very different to the way you trade a daily chart. So how can we achieve any measure of consistency if we're just completely changing the environment? So that's not a very, again, not a very good way to trade. But if you don't know any better, it's obvious. You look at trading opportunities, you look at different charts, and you are able to change that time frame, that periodicity, and look at different time frames and look for different. I just don't think it's a very good way to trade at all. So really, when it comes down to it, what's the best periodicity? The best periodicity is the one that's going to suit your trading style the best. But more importantly, how do we identify that periodicity? And this is a concept that I developed that I think helps people provide a little bit more of a focus and a clearer idea of what their trading style or time frame should be. So I want you to go to the far right first, the right-hand column, which is average trade duration. Even if you are not trading now, you probably have some visualization of what you want your trading to look like. Stand at your office door and look in on yourself. Look in on yourself in 12 months' time. How are you trading? What's that visualization you have for yourself? What currencies are you trading? What products are you trading? What stocks or indices or commodities are you trading? And how are you trading them? Visualize that. Then try to determine what your typical, average, profitable trade looks like. Your typical, average, profitable trade. What does it look like? How long does it go for? You should be able to give yourself a time frame in there somewhere. And I could add another one, and that is weeks to months, and I could have a trading style attached to that of medium term. But most people should be able to slot themselves into one of those categories on the right-hand side there, and then simply work your way across to then assign yourself a trading style. I am a short-term trader. I trade very short-term. I trade medium term. And once we've identified that trading style, then more importantly, we can identify a chart periodicity or time frame to best complement and support that trading style. If I'm going to trade short or medium term, do I really need to look at a 5-minute chart? When I'm looking at months and weeks, do I need to look at what's happening every 5 minutes? I don't think so, and I think it's a waste of my time doing that. So we need to identify a periodicity which best supports, complements, if you wish, the trading style that you have developed. And that's important, because I don't want you running that menu of looking at just all the different periodicities and trying to work out, and find an opportunity from that. I don't think it's a very good way to trade at all. Now, finally, not finally, but just importantly for today's session, how do we go about developing rules? Right? How do we begin this process of putting together something that one day we have a lot of confidence in and that we can follow like a really, really good trader does? And that's our goal. That's the position we want to get ourselves into. And it's a really good position because you get to the point where you could not care less about what anybody else thinks about the market. You could not care less. You don't watch any more TV shows on financial commentary. You don't read anything anymore because you have so much confidence in your own process and the strategy that you have in place, and you are just very comfortable and very confident following that. You don't care what anybody else thinks. It's a great position to be in, and it's a position well worth going after and trying to get to that position. Excuse me. So how do we get to that position of putting together a set of rules? Now, the vast majority of people that I speak to have traded a little bit, and they have certainly undertaken some form of training in even just technical analysis and understanding what a candlestick is and understanding all the different types of charts, whether it be a candlestick or a bar chart or a line chart, understanding some indicators and moving averages and support and resistance levels and like. They have a basic understanding of technical analysis. So if I was to say to them, oh, and if you look at this MACD, they know what I'm talking about. But what they haven't been able to do is take the next step and put those things together into a strategy and a compilation of rules that is going to work for them. Because we are almost inundated with different ideas when it comes to technical analysis. We go and have a look at chart patterns and we learn about all the different triangles and pennants and wedges and flags and the like. And then we learn all about those indicators, and there's hundreds of them, and MetaStock has, you know, a lot in there. So which one do we use? Do we need to use all of them? Do we need to use none of them? How do we find out? So we have a very good basic grounding of knowledge when it comes to technical analysis. We just struggle to put it together. This is the process that I think helps a lot of people put it together. And we get to the point where once we've developed our rules, if we see something that we know about because we recognize a pattern and we see, oh, that's a descending triangle, we get to the point where we no longer care, we no longer trade that because it's not part of our strategy. Even though we know what it looks like and we recognize it and identify it quite easily, that doesn't matter because that now is no longer part of our strategy. So this is a very simple process, but it takes a lot of time. Please do not have me misrepresent that. This takes time to get this, but it's the beginning of a journey of trying to put these rules together because that's what you need to be able to do. So firstly, we are going to look at some data. We're going to look at some price, literally looking at charts. So if I come back to MetaStock here, that's the index. I'm going to go to another company. Some of you have physically been to this company's major asset, and that is Sydney Airport, an hour's flight away from where I am. So this is a stock, and we say to ourselves, this is a daily chart. It's moved very, very, very well in the face of global indices and equities not moving so well and not having a great time. There are always some resilient stocks. There's always those that literally buck the trend and almost oblivious to what the rest of the market is doing, and they continue to perform. So even in the poorest of times, there's always opportunities. We just need a process of being able to find them, don't we? So we look at something like this and we say, how could I have identified, or let's look at some data. And what we're going to do from that data is make observations. We are going to say that I would have loved to have bought it down there or found it when it broke through that level there. You know, obviously I've got my trailing ATR stop on this particular chart at the moment. But let's say, you know, how could I identify when it broke through to this new high around here? Hopefully you can see my mouse okay. When it broke through to this new high here or this new high here or this one, is that something that I would like to do? Is that something I would like to find those stocks when they move to new highs? And if I broke through on this high here or this or this or this, my trailing ATR exit did a very, very good job of staying away far enough to allow me to enjoy and in fact continue to enjoy this particular stock and what it might do in the very near future. So is that something that I would like to identify? If that's the case, how do I identify that? How would I program that, so to speak? How would I write that down in English, in just plain English, in a technical analysis sense, to identify that stock that did that thing, that actually that occurred, or make that that particular condition occurred? So I'm saying look at some data and then make observations about that. And I'm not saying you need to trade that way, please don't get me wrong. And I could get out my ignition system and I could find some a lot shorter term opportunities or shorter time frame opportunities, but the process is the same. We identify the turning points more with ignition and say how can we develop rules to find when that stock did that and reverse that. It could be a matter of just looking at the candlesticks or looking at the bars to try to identify, you know, particular candlestick formations that we've seen, or or what have you. We could put a moving average on here, and I could do that very simply here, obviously. I could just put on something as simple as a 55-period simple moving average as an example, and you can see that on the chart. What do I put on there? 55%. It's just something like that as an example. I might just change its color. Actually, just give me a second, make it a bit more obvious. Just as something as simple as that. You know, that could be something that we put together. So now we have two conditions. Maybe we put in a third. Maybe I'll look at volume, and I can see here the volume is reasonably consistent, but I still want a minimum. I want liquidity conditions as well. So I need to put that in as well. But I might have a rule that says, yep, so it's moved to a new X period high. It is trading above that 50-period moving average, and that 50-period moving average is going up. I could put in a volume one, I could put in a volatility base, make sure it's not too volatile, make sure it's not lacking in volatility, etc., etc. So all of a sudden now, we are starting to get, I'm actually sharing with you some of the things in the altitude system, but these are some of the things that we can put together to try to develop some rules on how to trade observations that we are making in a chart. As I said, it doesn't have to even be a stock. You can go and open up a currency, open up an index, and try to make observations about how you would want to have traded that. And I know you cannot go back in the past and trade, but what we can do is begin the process of trying to define some technical conditions or rules that would have allowed us to have traded those opportunities and traded those observations that we have made. But just because we have found a set of rules that did a good job of finding this particular stock as an example, doesn't mean that's going to work on all of them. Doesn't mean it's going to work well over time. So we then need to begin a process of validating those rules. So now I've looked at some data, I've made some observations, and now we're going to define rules on how to trade those observations, and then we begin the process of validation, testing, proving or disproving. Obviously, MetaStock has the system tester in it, and it's had in there for a long time. I'll be open with you. When I began this process in 2000, I had MetaStock. I didn't use the system tester for no other reason that I had the time and I wanted to see the results myself. And as appealing as it was to click a button in the system tester and 10 seconds later be fed the results, I wanted to actually see the results. I wanted to see the trades unfold bar by bar, and that's literally what I did in MetaStock. You know, using the Shift key and pressing the left or right arrow to move forward, period by period, and that's what I did. Interestingly enough, as a side note, not by design, I actually learned a lot about technical analysis by doing that and spending that time looking at all those charts and doing the testing or the validation. And then, of course, we can begin to trade the setup, whether that be reduced trading amounts or whatever, but then obviously continue to review and always look to improve and just be open to new ideas. Now, we could spend a lot more time doing this and go to different charts and try to identify, in fact, what I might just do, if you bear with me for a second. So I just ran a scan just before. Excuse me. So I don't know any of those stocks, so I'm just going to pick open one of them. Hopefully it's a decent one, got enough liquidity and it's not too illiquid. Just wait for that to come up. Of course, I could have opened all these before we started, but I did not. Okay, that's not a great example to see. I'll go back to the first one that I found, and that's this one here. So this has generated a short signal. So hopefully you can see that okay, and it's come through. Just attach the ignition. There we go. So that's now generated a short signal for this. So, you know, simple thing of, it's obviously found this reversal here. It's waited for a bit of confirmation. The longer term trend is down. It doesn't look overly liquid, but it's obviously liquid enough and met the parameters that I've set. And as an example, what we're doing is just simply identifying, you know, technical conditions that would have identified this particular trading opportunity to me. I'm just going to randomly just go back to the previous one it just found in that exploration. There we go. So here's another one that it's found. So Again, it's found this reversal signal here. Longer term trend is down, albeit if you look at the ribbon down below, it's only just started. But this is the great thing about the exploration is we set up the criterion, the exploration does all the work, and we only then look at opportunities that have actually met our rules. We don't begin this process of randomly looking for trading opportunities. Look, I really just need to move on. I don't want to undersell this process here. To me, this is the most important slide in my entire presentation, and that is how are we going to move from, I see this too often. I have coached hundreds of traders, I have met thousands, and I've spoken in front of tens of thousands. And this is such a common problem of having pretty reasonable understanding of technical analysis and markets, and they understand the platform, they understand the software, they know how to open a trade and close a trade. They've heard the word stop loss, so many times it's not funny. But they really struggle to go to the next level of eliminating most of that and just putting together a very simple, clear-cut set of rules with very clearly defined criterion that allow us to identify trading opportunities, because that's what real trading is about. It's trading those opportunities which present us a high probability of having a positive outcome. So I cannot overstate how important I believe this process is. Even if you go and purchase a trading system, and you purchase my altitude system, I would hope you would still do steps 4 and 5. I would still hope you would go through a process of validating. It's your money, and hopefully you would respect your money better than anybody. So it's your money you're putting at risk. Still give yourself a little bit of confidence in that the rules that are being developed for you are going to give you some chance of success. Just to finish off with a few things, I notice my time is very, very quickly running out here. Excuse me. I mentioned before about using things in isolation. So here's the things that I use. I always look for trend and look for trade with trend. I have either a candlestick pattern or patterns or a chart patterns which allow me to enter into that trend that I've identified, and then I'm always mindful of key levels, support and resistance. So the good thing, of course, is coming to an exploration. And let's say, here's just a very short list that came up for me today. So again, just waiting for that to come through on your screen. So here it's presented to me 8 opportunities to go short today on my short-term system. I am not going to trade all 8. I can tell you that right now. I'm not going to trade all 8. So I am in a position where I can look for the best opportunities and the ones that I think, perhaps things that I haven't been able to code into MetaStock. Things like key levels that I'm very aware of but maybe are not coded in. Well, that's where I'm allowed to have the discretion to say, well, those, 7 of those are no good, but that one is, and that's great, because I'm not looking at 2,000 stocks anymore. I'm only looking at those that are presented to me, which I think is tremendously advantageous. A couple of quotes just to finish off towards my last point here. This is a quote from one of the market wizards interviewed in one of the Jack Schwager books. I certainly highly recommend, certainly the first book. Any of them are pretty good, but the first book I absolutely love. This is stating the obvious, but I think it's important to state it. You need to determine why the winners are winners and the losers are losers. Once you can figure that out, you can become, keywords, more selective. You can become more selective in your trading and avoid those trades that are more likely to be losers. This is my process that I talk to people about all the time. It provides people structure. It provides people a framework to build their routine or their process around, and I think this is absolutely critical. The frequency at which you go through and do this really depends on your trading style. If you use daily charts, I don't see a reason to go through this process any more often than once per day. I don't see it at all. So this is the process that I talk to people about a lot. This helps with consistency. It helps us do what we need to do, but then do that over and over and over again. So step 1 is just to monitor anything that's open. Steps 2, 3, and 4 are the process of looking for new trading opportunities. Once we've done that, the remainder is risk management and execution So determining stops, determining position size, executing the trade, and then very, very importantly is go and do something else. One of the worst things you can do is just sit there and watch your trades, but if you don't know any better, that's probably an obvious thing. People think that's what traders do. They stare at charts, they stare at flashing numbers, and they watch their trades. I think that is a horrible thing to do, in my personal opinion. Okay, a few more quotes for some market wizards, and then I just want to finish off with one final point about the importance of consistency. Here is about strike rate. This is one of the guys, along with Richard Dennis, which is the turtle traders, if you've heard that sort of story about the turtle traders. He's one of them. The desire to maximize the number of winning trades or minimize the number of losing trades works against the trader. The success rate of trades is the least important performance statistic and may even be inversely related to performance. So don't strive for that really, really high strike rate, that high percentage of profitable trades. Really, from a risk management perspective, it's not as important as you think. As we say, it's not how often you get it right or wrong, it's what happens when you get it right and wrong. I'll flick through that one. And finally, Ed Seykota, again, another market wizard from the original Market Wizards book. And here I'm just trying to paint a picture of what he does. In order of importance to me are 1, the long-term trend, 2, the current chart pattern, and 3, picking a good spot to buy or sell. So his trading strategy is a combination of different things that are all supporting each other. The chart pattern may have little correlation with the longer term trend, but it's good to put those together to ensure they're all in alignment and all, helping us get into a higher probability opportunity. Finally, on the entry, just keep in perspective how important really is your entry. I always believe in having rules that are repeatable. People talk to me about fundamentals all the time. They talk about central banks and governors, and they mention things like Draghi and Yellen and Carney and the like, and they say, oh, what if he says this? Blah, 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 et cetera, et cetera. I say, yes, that's wonderful, but how repeatable is that strategy? How repeatable is that idea? And that's the great thing about technical analysis. We can define rules that are always going to repeat. That example I mentioned earlier of 2 moving averages crossing over each other is something that will repeat always. Now, again, I'm not saying that's the best strategy, but that's how we need to think, is how can we, have a set of rules that allow us to constantly get fed opportunities. I very much believe in simplicity. Simplicity works, and I believe in time frame being more important than you may think, and clearly identifying your time frame, not somebody else's, not that person over there, but yours. And the rules that you develop to support that time frame will flow on from that, and they'll be different to someone else who trades a different time frame. And the final point I wanted to make about consistency is this particular thing here, and I'm sure you're all familiar with what I'm showing you here. The greatest exponents of consistency and having a set of rules that are in their favor and applying those rules every single time is a casino, and as an example, this particular table, this particular game. The payout odds for first 12 or odds and evens and blacks and reds seem very, very fair. It's 2 to 1 or it's 3 to 1. It seems fair. It seems it's the way it should be. But of course the edge that the casino has in their favor is the 0 at the end, because that 0 places the odds ever so slightly in their favor. So when they have odds in their favor, they apply this set of rules every single time the white ball gets put onto that spinning wheel. Every single time. And not every single time when that white ball goes and rests in a number does the casino make money. Not at all. But over the course of a period of time, over the course of one day, a week, a month, they're basically guaranteed to make money. We as traders, I believe, can think in a very similar way. If we develop a set of rules that provide us an edge, good reward to risk, probability, and all those expectancy numbers add up and are in our favor, we can then apply that edge and apply that set of rules with unbelievable ruthless, robotic consistency, good things might happen. And I think that's something important that we need to have a think about. Okay, I need to, if you don't mind, I've just quoted myself. How does that sound? Out of my own book. I want you to commit to mastering, becoming the absolute expert at your setup, at your strategy, and then execute that with great discipline and consistency. Okay, I need to finish off here. I'm sure the other staff around might say a few words about this, but my trade launch systems, which came out earlier this year, has 3 systems, but the 2 main ones are altitude and ignition, and it has a lot of other little indicators that I put together over the years, including that volatility percentage one that I mentioned earlier. Ladies and gentlemen, as the hour finishes, ladies and gentlemen, thank you so much for your time. I really, really appreciate it. Again, I appreciate the opportunity and invitation to speak. So it's been my pleasure. I hope I've been able to provide you some food for thought. And with that, I'll wish you all a very good afternoon, and I'll hand back to the staff who can say a few final words. And thank you very much.
Great job, Stuart. Lots of interesting insights and philosophies, pardon me. A few things some notes that I was taking that I wanted to pop in. I really like that you should really reinforce that not to get too distracted by all the features. In a technical analysis software like MetaStock, I certainly agree. Find a system that works and stick with it. I also like what you were saying about consistency, patience, and keeping things simple are also very important. Finally, I like that step 8, turn off your computer and go do something more productive. I think we can get sucked in and to things and not or let it take over our lives. All right, so in terms of Stuart's trade launch system add-on, if you'd like to check it out, we have a video on our website. You can go to metastock.ca/Stuart. And you can, there's a video that goes into it's a short video, but it goes into the details of what the trade-in or the add-on actually does. So again, that's metastock.ca/Stuart. The regular price is $3.99. We have it listed on our website for $3.59, but if you purchase it within the next 24 hours, you can save an additional $30, and these are US dollars, of course, and that reduces the price to $3.29. But to take advantage of that 24-hour sales price, you need to use the coupon code Stuart2015, and that'll get you that price. So again, if you would like to take advantage of it, you actually want to go to metastock.ca/Stuart, and you should see that in your chat box, and you'll be able to see that the pricing as well as the video if you want to check it out further. But thanks again, Stuart. Awesome presentation. Have a great time with everyone in Utah, and I also want to say thanks to everyone for your time today for joining us, and I hope you found some benefit from it. So enjoy the rest of your week. Take care.